I'm now joined by MF Global's Jessica Hoversen. Thank you very much for coming in to speak to us.
Thank you for having me.
So we've seen the dollar fall to a 15-year low versus the yen. It's weaker since January against the euro as well. What is the catalyst for this?
There are two catalysts for the dollar right now. One is the weak backdrop of U.S. economic growth and also the outlook for Federal Reserve policy, which, given the FOMC minutes, continues to be that of quantitative ease.
Exactly. When we're looking at the prospect of another round of QE in November or December, does this mean more potential weakness in the dollar in the coming months?
I definitely think so. Right now, the markets do look a little overextended. If you look at dollar-based crosses, everything seems to be at its high. And right now, markets, I think, are very, very hesitant to move any further. So we're probably going to either need a little bit more consolidation or even a pullback to get a catalyst to get those crosses to go higher. However, I do foresee that coming, given what we saw with the MBA purchase index. Obviously, the housing market in the U.S. is very low. U.S. consumer confidence also very weak. And also, I think the comments from the Federal Reserve governors will be able to push the dollar lower.
And what might a second round of stimulus in the U.S. mean for emerging market currencies?
Well, China would argue that further quantitative ease would trigger not only inflation in commodities, but also hot money flow into these EM currencies. I think if you look at the upcoming G20 meeting, it actually could be a catalyst for further appreciation in those currencies, namely simply because you don't want to be the one currency that is the most aggressive intervener heading into that meeting. If we look back into the G20 Toronto meeting, one of the major points that we left the meeting with was that competitive devaluation would be avoided. However, as we head into the South Korean G20, it seems as though many people are disobeying that pledge. And so I think going forward, you could see some aggressive appreciation in those EM currencies. So again, they are not labeled the most aggressive intervener going into the G20.
You mentioned a weak housing market in the U.S. Economic growth has been slow at best. What do you make of the divisions that we've seen within the FOMC about the benefits, about the effectiveness of another round of stimulus?
To be honest, I think at this point the Federal Reserve is operating on a wing and a prayer. I think they recognize that U.S. economic growth is very weak, but further monetary policy may not actually stimulate the market. They know that fiscal policy, really right now what we need is fiscal policy. The Fed, as much as they would love to print jobs, they can't. They can only print money. So right now, what they believe is what they're trying to do is to lower interest rates, possibly generate a wave of refinance to give the entire economy basically a raise, and then hopefully trigger export growth via a weak dollar.
And Jessica, tell me a little bit about the risks of further stimulus. How might it affect investor confidence in the U.S., particularly when we're talking about fiscal credibility?
Well, of course. Well, one of, I think, the major concerns of right now is that the Federal Reserve could actually pursue an inflation target. So you increase the target from 2% to 4%. Now, there are many of the honing especially, that believes that that is completely preposterous, and that would deteriorate credibility immensely. And I have to believe that I am in that camp as well. I think increasing the inflation target would just erode investor confidence.
Okay, Jessica Hoversen from MF Global. Thanks very much for coming in.
Thank you so much for having me.